So we do our very best, which is very bad, at explaining this whole Silicon Valley Silicon Valley Bank fiasco.
Didn't realize we started.
We make some terrible puns about the FDIC in the US, and that's pretty much 20 minutes for you. So
and here's what you need to know. Peter starts out very excited. Then we get bored for about 3 minutes, and then we pick up the SVP talk. So if you don't want to hear about the Credit Suisse stuff, just jump ahead to like minute 4.
Credit Suisse.
Yeah.
And you're good.
3 minutes in, 2 minutes in. Yeah, that's good.
Yeah. All right. Enjoy.
Welcome to the Not So Critical Update Friday edition. We're talking about Credit Suisse in Christ Suisse. What went wrong, pundits are asking. It is on everybody's mind, and actually nobody really cares about Credit Suisse, but we do care about Silicon Valley Bank. So
yes, we do.
We
cared about that last week. I've moved on.
Well, we kind of are.
So, John Oliver, welcome. Just screaming.
Was this the intro? We don't have to go back and record it at the end now? I think that's true.
No, I think we should definitely do an intro for an intro. Double
yeah,
deal. All right, let's pick it up there.
A double entendre, you might say.
So let's get this part out of the way first then. So this story is about Credit Suisse in crisis. And the tie-in is that they had been down for the past quarter. Yeah. More recently, the SEC queried their annual report, forcing them to delay their publication. This caused some uncertainty about their stability. Then SVB, Swiss, you don't want to talk about this, Peter. Then the Silicon Valley Bank failed, and that triggered everybody to want to get out of anything that looked risky, which this bank now did because of their query, and now they're getting bailed out by the Swiss government.
So also something super important to note is that like Credit Suisse is just rife with trash. Like they have been. Sorry, do you want me to talk?
Yeah, I'm just going to do it on my own
image.
Yeah.
They have been they've been like laundering or like helping money launderers through, with like in relation to drugs and human trafficking, like really bad things. Like spotlight's been on them for a while. Not great. So like Mike said, the Silicon Valley Bank fiasco that happened last week, and the other smaller domino affected banks, what's the other two? Silver Lake, is that what it's called? And then there's another one I'm forgetting the name of. Like these smaller banks are now kind of falling in thanks to Silicon Valley Bank. And now like this is a really big bank. Like Credit Suisse is like a 150-year-old bank. A lot of prestige and sketchiness associated with this bank, and now they're like basically dying. But thankfully, I guess the Swiss National Bank is stepping in to save the day with like something like a 53 billion with a B dollar loan.
I'm just glad it's not the Fed. All right, Peter, go.
Okay, so what's really happened here is that we wanted to talk about Silicon Valley because everybody's been talking about Silicon Valley Bank all week. I do, but Mike didn't want to because the problem is
we're late to the party
because we're famous for our on-point, timely recording, and we're like because of our recording schedule, we didn't have a few. I suggested that we do an emergency recording at the weekend.
You did.
And I was
we
just
should have. That's true. You definitely did.
Yeah, we should have definitely. But like also, the world works around our time in our schedule. I know. Not the other way around.
I'm just trying to get people insight
search engine optimization does not.
Something so boring as Christ Suisse. I do like that pun.
Swiss cheese.
I'm going to keep repeating Yeah, that's good. That's good. Here's the thing about the whole crisis, right? A couple of things. First of all, I very quickly get to the point where I don't understand what people are saying. I think this must be what it's like when I start talking about DNS security to other people, because there are so many terms being thrown around that I just switch off. Yeah, I can't keep track. It's a really interesting phenomenon, and I wonder if it's what I genuinely wonder if it's what I make other people feel like, and I don't think that's a good thing. Anyway, the second thing is the weird. So when I first heard Silicon Valley Bank, I was like, it's one of those tech bro startup things, and it is to some extent, but it's also actually having a lot of impact on real people, which is really weird. Like, it's crazy that all these people who had their money, all these like Peter Thiels of the world, had a bunch of money in there. They went on a bank run, which seemed very what's the thing for murder?
Very coordinated.
No, premeditated. That's
sure.
it. Premeditated and coordinated. Yes, exactly. So they were getting they got their bonuses on the Friday. Everything fell apart. They all sold all the C-suite sold a bunch of stock back in December, like up to 30% of their stock, which is bonkers. And then they went on a bank run, basically collapsed the whole thing, and then complained that they weren't getting a bailout, which is like, it's also blatant and horrible. It just seems crazy.
I guess for people who've been hearing about this, who might not understand what happened, I'll do my best to explain it in like layman's terms, because I had to also I'm not a finance guy. I'm not an economist. I don't know.
Despite
I had to look for, despite the looks. And
I mean, people would look at you and think, finance, bro. Yeah.
Definitely. 100%. Off the street, go back to Wall Street.
He should be called Jared.
Jared or Blake.
Mike, Pete and Jared in the not so financial update. Yeah, go on. Sorry.
So the way Silicon Valley Bank was trying to make money was through these mortgage-backed securities. And if you've heard of the 2008 financial crisis, this is basically a very similar situation to what caused the meltdown of the economy, the U.S. economy. And then, but Mike, you look super like you're just ready.
No, I'm absorbing.
Okay, so there's these mortgage-backed securities that you can put your money into to make money off of the real estate market. And the reason it was really lucrative is because there was no interest rates provided by the U.S. government for loans, right? So the U.S. government, Mike, correct me if I'm wrong at any point, the U.S. government is able to hand banks money at super low, near zero interest rates. Well, that changed last year because of inflation, and they wanted to fight inflation by raising these rates. And that is why you'll hear something like the mortgage rates right now are super high. Like they're at like 7%, 6%, where traditionally we were seeing them at like 2 or 3%. And so back to the whole mortgage-backed securities. Well, they weren't really making much money anymore because of these interest rates from the feds. So when people heard about that, customers of Silicon Valley Bank heard about that, they started pulling out money. So Silicon Valley Bank had to sell these securities to make up and stay liquid. And then when customers of theirs heard that they were selling to stay liquid, they wanted to pull out even faster. And then basically that was the effect to push people into a bank run, meaning everyone pulls out money at the same time.
So
go ahead, Mike.
Also not an economist. But my understanding, I think, was a little bit different. So driven by interest rates, yes. Interest rates being driven by the mortgage-backed securities, okay. The way I understood it was that they had been invested in low-yield bonds, which are safe, but they were overextended, which could have been fine if nothing went wrong, Peter.
No, it just struck me that is a classic example of where my brain just falls apart. The term low yield bonds. Well, so I can kind of figure it out.
One way or the other.
I don't really know. Yeah.
Let's leave it at they were stable until they decided they wanted to make more money, at which point that they were overexposed revealed itself and everybody ran the bank.
Yeah. See, now that makes much more
there you
sense.
go.
Thank you.
I should have started with that.
So
we should start with that. Let me write that down.
The sketchy thing, well, sketchy in my opinion, is that Silicon Valley Bank funded a lot of startups.
Yes.
And they did so by handing them loans instead of investments. And they said a clause in the contract was something along the lines of like, you can get this money, but you have to hold it with us. So these startups received, let's say, $2 million in funding and through a loan instead of an investment. And the clause in that agreement for the funding was like, well, you'll get it from us, Silicon Valley Bank, and you have to store it with us. You have to keep it with us, Silicon Valley Bank. And then boom, like now you don't have access to your money anymore. You can't pay your employees anymore. Like such a nightmare. And then there was like screenshots of these VCs all over the world who were basically like messaging founders the Thursday before the bank closed, being like, pull all your fucking money out right now, like you will lose it all, which only fanned the flame more.
$40 billion taken out in a day.
That's crazy. Crazy. Yeah.
Now, the bank itself is not a tech startup. They were holding the money of a bunch of tech startups. And the bailout, so people defend the bailout by saying it's not a bailout for the bank. It's basically just extending the FDIC insurance beyond the $250,000 limit that would normally be in place. And they're doing this by leveraging more of the insurance fund and doing some other basically they're guaranteeing the investments that are now worth 80 cents on the dollar for the full purchase amount, which seems super shady and is definitely a handout to the bank, because they're basically sending the banking industry a message saying that like, go ahead and overextend yourself because we'll just insure you well beyond which and then
they're paying the ransom.
Well, I mean, in a way. So it's true that the people being bailed out are the depositors, which, okay, they should be. Well, we'll just say they should be for now, generally speaking. But the argument is that, well, this isn't really costing the government anything. This isn't going to cost the taxpayers anything, which makes zero sense to me. Because if we're guaranteeing the investments for more than their current market value, that money is coming from somewhere.
Yeah.
It's not. From what I understood, the way the FDIC is going to handle this is that they've seized all assets owned by, well, I guess that were owned by this bank, and they're now selling everything to first make the insured customers fully whole. And then they'll go to like the uninsured, and then like I forget what's past the uninsured holders, because the FDIC, their whole goal isn't to be like 250,000 for you, 250,000 for you. Their whole goal is to basically get everyone's money back into their accounts, not at this bank, obviously, and to do so with the least amount of money spent. And that could be a scenario where a big bank, will say something like Bank of America, steps in and buys Silicon Valley Bank for like $1.
Yeah, HSBC did that in the UK.
Yeah, but Bank of America then has to pay out these customers. Now, Bank of America, by doing this, they get exposed to 10, 20, 30, 40,000 customers who can then start banking with them, right? So it's kind of like almost a very, very expensive PR move. Because it's like they're, and I'm not saying that Bank of America is saving anyone. I'm just using them as an arbitrary example that like someone like them could step in and save the day, which is good optics. And those customers might start banking with them. Right. It's a marketing.
They're going to calculate the cost per acquisition or cost per lead. And if they think it's worth it, they'll pay it. So it's marketing, I suppose.
Yeah.
So
in a way,
they were stable until they overextended themselves, and then they exposed themselves to risk. Is that how you?
Yeah,
well,
basically,
they already had overextended themselves. They were taking more risk than they should have been. It was exposed that they were doing that when they tried to basically do it more.
Yeah. So once the public found out that they were doing this well beyond what they should have been, that's when people started worrying and started taking money out. And then it was, each day was worse than the next. And
the public is whom? It's
customers.
Like
it's customers. It's like shareholders. Like people talk. You know, so when they make a move, or let's say every quarter they have to. I think it's every quarter they have to share a report with their shareholders showing how they're doing, right? So if the shareholders get this report and they're like, wait, you have how much money in these worthless mortgage-backed securities or low-yield bonds? You're really overextended. This is super high risk. You might lose everything. We're pulling out. We're selling all of our shares. We're pulling out. And then Tom down the street gets a call from his friend Tim, who's like, hey, you won't believe it. This is what's happening over there. And then Tom's friend is banking with them as a startup founder. Right. You see, that's how it probably went, more or less.
Yeah.
If we want to paint a picture to it.
Yeah, interesting.
And then from there, so the libertarian in me wants to say, you know, these bankers say that, you know, the market will decide if these are good banking practices or not, except the market won't decide because the depositors have now been insulated from any consequences. So for everybody kind of wins here. The bankers get bailed out. Sorry, the bankers get to walk away. The depositors get bailed out. There's no incentive to do anything whatsoever to change the system moving forward. So the libertarian in me wants to say, like, all right, well, the depositors made a bad choice by saving with a bank that made bad decisions. Like, they should bear some responsibility for that too. It feels super cold-hearted to say that. I don't know if I'd have the balls to actually like make that decision, but I don't know how things change in the system. But the more infuriating part is the political response about how this was only happened because of the diversity of their board. And if their bank had been run by 12 old white guys...
Who wrote that? Was it the Washington Journal that wrote that or something?
It was insane. I think it was DeSantis who kicked off that messaging.
It was like
people ran with it.
It was like they were like, I'm not saying that because they had a diverse board this happened, but I wonder if it would have happened if they were all straight white males. And it's like,
no, it was the other way around.
Fuck?
I'm not saying 12 straight white males would have been able to fix this, but maybe if they didn't have the diversity,
right? Maybe if they worried less about diversity or something.
Yeah.
Dude, who fucking thinks like that? Like, where did you find this? How many hoops did you jump through?
They typed it out and went, nailed it. And then the editor
went, imagine that getting passed up, right? Like, you got someone who's writing it, then the fucking chief editor is like, yeah,
it's an opinion piece, man. It's just an opinion piece.
Like, send, full steam ahead. Just absurd. But
not just really go. No, you cannot put that on our website. Yeah, no.
Some politician tested it with a market group who went, yeah, we agree with that because we hate them too.
Right,
and then it was just spun off from there. It's
because screw women and anyone who isn't me.
Like, you literally can't say that.
Yeah,
and say you're not.
No, stop there.
Biased.
It's absurd.
It's ridiculous. So that to me was almost the most frustrating part, other than the fact that we know for a fact this is going to cost the taxpayers money, no matter what they're telling us.
I mean, the FDIC. Who pays the FDIC? Like, that has to. Who pays this? I'm not saying I'm not. Right, FDIC. Who pays these employees? Like, these government employees? Like, that has to be taxpayer money, right? So. I can't imagine that they're getting paid from the insurance fund that the banks pay into.
Yeah. So is it a big organization then?
Is it a what?
A big organization?
Yeah, it's very
long.
Yeah, they're horizontally large. They scale horizontally, Peter.
The FDIC is
good.
I
missed that.
Yeah, it's very large.
I got it.
Yeah.
I got it.
So with strain and like excitement in the market, it actually grows larger.
Really?
Of course, because they expand operations when things are.
It seems to have been
exciting.
A fairly limp response to what could have been
at first a very flaccid response from. FDIC,
which can happen to anybody, it can happen to any governmental organization.
The government body, specifically the government body, FDIC, really limp, flaccid response at first, but then kind of boiled over.
Well, they did shoot money all over the problem.
Wow.
What you might call a money shot.
A money shot.
Yeah, they really came in and ejaculated money everywhere.
Whoa, John, come on now.
Too close?
John, hey.
Sorry.
All right, let's get out of here while we still can.